I'm going to get us live and we're kicking off in about 10 seconds here. Awesome. So we are now live on Facebook. I want to thank all of you who are dialing in through Zoom to join us live for this session. For those of you who are live on Zoom, you can post any questions that you have here in the Q&A. So I'll be looking first and foremost at the Q&A and then secondly at the chat. And of course, if you want to actually ask a question by opening up your audio, please just click the raise your hand button and I'll open up the audio for you. Today's session, we're going to be talking about what types of things you can deduct through your business. And specifically our agenda here, sorry about that, is to go through how we at CPA4IT add value, a little bit about our process, our chart of accounts and why that is important, then the various expense accounts that you need to be aware of for how to categorize those business deductions, and then of course asset accounts and how that relates to depreciation. And then lastly, we'll close up with some additional resources and some tools where you can go to get more information should you have any further questions. If you are watching live on Facebook, you can post your questions down in the comments below, and we will be sending those over live through one of my colleagues, and they'll be sharing them here as questions, and I'll do my best to answer those. Just bear with us, as Facebook questions do sometimes have a bit of a lag before they come through to the live event. So if you've got questions, make sure to get them in early if you are on Facebook. So without further ado, I'm going to kick off and tell you a little bit about ourselves. For those of you who aren't already clients, CPA4IT is an accounting firm based here in Toronto, servicing small business clients all across the country, with the exception of Quebec. Unfortunately, we do not do any Quebec returns. A couple of ways that we add value to our clients is our unique audit representation protection, which means if you are ever audited, we'll represent you up until the third and final stages of appeals if you have our audit representation protection. We also do a financial benchmarking to compare your information, your revenue and your expenses against the average and the median in our database. This is a tool that helps us quickly identify opportunities as well as risks, and allows us to do that before CRA can, so that if we do have anything that is potentially a red flag, we are doing everything we can to put the documentation in place to make sure you can keep those deductions. We also do proactive strategic planning with all of our clients, sort of figuring out how much money are we going to keep in the corporation? How much are we going to take in salary? What's our long-term goals? And we'll do a personal net worth assessment with every one of our clients, looking at where you are now, where you want to go, and how you're going to get there. We also do financial quarterbacking by bringing in resources like tax lawyers and financial advisors and insurance agents and bankers where and when necessary. And if you don't have those resources on your own team already, we have people that we can recommend or refer to you. We also offer a business coaching and management training program called our Value Builder program. It's designed to help you get the most out of your business. It's run by my father, who's been in this business for well over 30 years. And prior to that, has owned restaurants, has owned travel agencies, has owned business schools, has done a myriad of businesses, and has a wealth of knowledge to help coach and mentor you to success. And then, of course, we offer our seminars and webinars like today's event. We have webinars about every 2 weeks, and we have tons and tons of social media content that we're putting out there regularly. So if you've got questions, join our Facebook group, connect with us on Twitter, on Instagram, on Facebook. You'll find tons of helpful information there. And of course, as your accountants, our job and our goal is to help you organize your finances, create wealth, and transform that wealth into a legacy. And we do that through financial planning. But enough about what we do for you guys. I want to tell you a little bit about our process when you bring in a year end. So we are an experienced firm. My father founded this, like I said, over 30 years ago. Over those 30 years, we've built systems and processes that have been augmented with technology over the years as it's evolved. And we have a very specific process that we go through when we bring in a year end. Starts with a login and a preliminary review to make sure we've gathered all the information from you. We then go into an initial data entry phase where we take that information, prepare income statements and financial statements for an accounting partner to review. They do an initial review to make sure it's meet our quality standards. And then we send over a copy of drafts to you to book a review meeting where we go through that financial planning, we review the financial statements, we review the benchmarking analysis, we do everything we can to maximize those deductions. Typically in that review meeting, a number of adjustments might came out of there, and we'll do that post-review data entry before preparing a final package, which we will have a final QA controlled by a senior tax manager who will sign off on the file, and at which point we will release the package to you for your final sign-off. We will not e-file anything with the government until you have signed off on your package, so you can rest assured that the information that we prepared, you have checked not once, but twice to make sure it meets your level of satisfaction. So that normal process takes us about 6 to 8 weeks. So it is important to realize that you can't just bring us in your information and say, my taxes are due tomorrow. We do need time. We do have thousands of clients, and we do build these workflows and these processes based on a first come, first serve basis. So typically it takes about 6 to 8 weeks. Sometimes it can be a little bit faster, and sometimes it can take longer. The reasons that it takes longer is if we basically have incomplete information or inaccurate information, and we have to go back and forth with you. So please make sure you bring in your information on a timely basis and you bring in a complete set of books. That will help us move through the process as quickly as easily as possible and get that file back to you in a timely manner. So now the real reason that you guys are here is to talk about what types of things that you can deduct. But before we can talk about that, I want to mention a little bit about our chart of accounts and what our chart of accounts is and why it's important. So a chart of accounts is a financial organizational tool that provides a complete listing of every account in the general ledger of a company broken down into subcategories. So this is basically the list of the places we're going to categorize how you earn income or how you report revenue, and how you record deductible expenses. Now I'm going to focus specifically today on the income statement and not so much on the balance sheet, although we will touch a little bit about it. But this chart of accounts does separate everything into revenue, assets, liabilities, so that we can prepare a financial statement. And this is really important because how we categorize these expenses is going to affect our benchmarking analysis. It's going to affect how we report this information back to CRA and how they do their own analysis comparing you against other people in your own industry. So much like us, they do something similar, a benchmarking analysis to see if you are keeping up with the Joneses, if there's anything suspicious, if there's anything red flags. So we like to go through that benchmark and use our standard chart of accounts so that we can benchmark you against the data that we've collected for over 30 years to show you how you compare to this average and the median, to identify these potential red flags, and also to identify the opportunities where you might be below the average in your deductible expense. And when you're below the average, it's not usually because you haven't spent the money. In most cases, it's because you weren't aware that there's things that you could deduct. Now, today, what we're going to do is walk you through our standard chart of accounts and the common things that you might deduct under each individual category to help you figure out, what can I deduct and what category does it go under? Again, if you do have any questions about whether you can deduct something or not, please feel free to post it into the Q&A and I will do my best to address that today. So without further ado, what is deductible? And I'm sure a lot of you would like us to be able to clearly define every single item that is or is not deductible. But the Income Tax Act, even though it's a very lengthy document, does not prescribe whether coffee at Starbucks is deductible or whether television could be deducted for business purposes. What it basically tells us is that if it's not specifically disallowed by the Income Tax Act, then the rules are it has to be spent with the intent of helping the business to earn income, and it must be reasonable. Intent and reasonability are both subjective and they're open to interpretation. At CPA 4IT, we believe our job is to help you interpret that as aggressively as you possibly can so that you can maximize those deductions. Now, we are a CPA firm registered with the CPA, the Institute of Chartered Professional Accountants, which means we will never counsel you to do anything fraudulent or illegal, nor will we allow you to do anything fraudulent or illegal that we recognize or identify. But pushing the envelope and maximizing those deductible expenses is not fraudulent and it's not illegal, and it's what you're entitled to do. Now, what we want to do is figure out how we can interpret the Income Tax Act to maximize those deductions and figure out ways that we can structure the way we spend money to maximize those deductions and to minimize the amount of tax that you pay. So with that, we're going to go through a couple of key categories, but I want you to remember the key category is if it was the key understanding that if it was spent with the intent of helping the business earn income and it is a reasonable deduction, that it should be deductible if it's not specifically disallowed by the Income Tax Act. And there's only a handful of things that are specifically disallowed. And I'll cover those, the main ones right off the top. So golf green fees, we get this question all the time. Unfortunately, your golf green fees are not deductible. The 19th hole, the drinks, the food, that's deductible. Unfortunately, the golf club green fees are not deductible, and neither are club memberships. These are things that are specifically disallowed. In addition, your primary home telephone line is specifically disallowed. Now, secondary lines, business lines, cell phones, internet, all of that is deductible, but your primary home telephone line specifically disallowed. In addition, insurance. Insurance, if it's life insurance, is specifically disallowed, but there's a bunch of caveats to that. So I'm going to get you to reserve judgment on whether you can deduct insurance until we get down to the insurance category, and I'll explain that in a little bit more detail. Now, starting off with our expense accounts, first and foremost, our fees, they are deductible, as well as any other accounting fees or accounting software that you might have, those fees are deductible. Pretty straightforward there. Now, advertising expenses is a little less straightforward. Of course, your stereotypical advertising expenses, social media advertising, those types of things, advertising in Canadian print magazines, which is falling by the wayside, but still happens. All that traditional advertising, of course, deductible under this category, but also gifts and even events. So if you were hosting an event, and I'm not talking about going out for dinner with one or two other people, I'm talking about, a New Year's Eve party or an annual event that you hold to invite. The criteria is invite all of your employees, which for many of our clients, you are typically the only employee, and many other clients or other people that you believe would help your business earn income. Now, if this is an event and it's a group event, we can deduct it here under advertising as opposed to under business promotion or meals and entertainment. And the reason that that is important is because advertising is 100% deductible, whereas meals and entertainment is only 50% deductible. And we will discuss that in more detail as we get to that section as well. Automobile expenses. Now, automobile expenses is our first what we call percentage of use account. Percentage of use account, what we mean by that is you can deduct the percentage that you use the vehicle for business. Now, for most of our clients, you're going to own that vehicle personally, and then you're going to reimburse yourself or deduct the expenses related to your business use of that. We do not recommend purchasing the vehicle inside the corporation because there are standby charges that have to be recorded and then gain or loss on disposal, a whole bunch of other issues. So if you were thinking about buying a car, we would say buy that under your personal name, and then you would deduct the expenses, your business use of that vehicle. Now, there are two methods. The actual expense method, where you take a percentage, so let's say that's 75 to 80%, and this percentage is calculated by figuring out what your total kilometers are that you drove as the denominator, and for your numerator, it's the business kilometers. That gives you a ratio. You multiply that ratio by all of the expenses that you would have, including fuel, maintenance, licensing. If you've purchased the car, you'll have depreciation. If you've leased the car, you will have the lease payments. Now, there are maximum amounts that you can depreciate, and there are maximum amounts that you can expense from a lease perspective. We will take care of all of that for you. Just tell us what you've spent, and we'll help you figure out how much of that you can deduct. For those of you that are curious, the maximum lease expense amount is $800 a month, and the maximum amortization for a typical car is $30,000. Now, there are some new classes for electric vehicles, but I'm not going to get into detail on that now. Like I said, if you've got a purchase, you just tell us what the whole purchase price was. We'll figure out how much to amortize. And again, if you're doing a lease, you record the full amount, and we'll figure out how much of that we can expense. Now, the other method that you can use is the mileage rate. Pardon me. When you're incorporated, CRA provides a rate that you can use for mileage rate reimbursement. There's a prescribed rate. It does change slightly from year to year. It's about 50 cents per kilometer. And in that situation, we don't worry about keeping track of, your fuel, your mileage, all of those costs, or your fuel, your gas, your maintenance, your repairs, your depreciation. We just simply keep track of the mileage driven for business. Now, you can imagine in this past year, 2020, where a lot of people didn't drive their car very much. In this year, it's unlikely that the mileage rate is going to give you the best deduction, which is why we encourage people to keep track of both methods so that we can get you the maximum deduction possible. Bank charges, this is pretty self-explanatory. The one thing to keep in mind is that bank charges on personal credit cards. So if you have a fee for a credit card, if it's a personal credit card, that is not deductible. But if it is a corporate credit card, if it's under the corporation's name, you can deduct those charges. So even if the personal card is used primarily for business, we can put it through, but CRA is likely to deny that if they catch it. So something to be aware of. Now, in addition, there are great points programs out there for credit cards. We've got a referral code if you're looking to get a points card. The American Express right now is, I think, offering 100,000 welcome points, and then there's 20,000 referral points if you refer anyone. So if anyone's looking to get a card, we're happy to send you our referral code because that gets us a bonus 20,000 points. And leveraging your points is a really great way to put more money in your pocket. But I won't belabor that. Next is books and periodicals expense. Now, our approach here is that everything that you read makes up your body of knowledge, which is helpful for your career and your job and your business. And that includes science fiction. It includes things that are not necessarily specific to the role that you're doing. It's all part of your body of knowledge. It can be everything from helping with water cooler talk and networking and relationship building. So everything that you read can be deductible under books and periodicals, from newspapers, magazines, books, periodicals, all of that. And oftentimes, when we used to fly and people pick up these things at newsstands, they would often not think to record them because they're small amounts. What I want to get all of you in the habit of is using a credit card for absolutely every single purchase that you make, even if it's only 50 cents, because there's not going to be a charge to do that. And it allows you to keep a full detailed record of exactly where that money has gone, which will help you when it comes to bookkeeping. Business promotion expense is a category I mentioned earlier. It's typically where your meals and entertainment is going to go. Unfortunately, under this category, CRA recognizes that you are getting a personal benefit out of these meals and entertainment, and therefore we add back 50% back onto the tax return when we file it. Now, this is something that's done by us in the tax software. It gets reported on your financial statements at 100%, so you don't need to worry about prorating it. But it is important to recognize that when you go out for meals and entertainment with one other person or on a regular basis, and this can be meals with clients, meals with potential referral sources, business meals with your business partner to talk strategy, which is often your spouse. All these meals can be deductible. Now, what the CRA does want for proof is they want a date and a time, and who you had that meal with, and what was discussed. Now, all of that can be kept in a calendar and is often not always required for every single event, but you should be prepared to provide that if you were asked. Computer lease expense, pretty straightforward, although very few people are leasing computers these days, as it's become a lot more affordable. In the early days, people used to lease computers, although some of those gaming computers can get up there. So if you have a very expensive computer and you are leasing it, it would go under computer lease expense, where we're basically able to expense the entire lease amount as you incur that leasing cost. What else do we have here? Computer supplies expense. So your computer supplies are any computer costs that you would have where you're purchasing the item. Typically, we use as a threshold $500. Anything over $500, we would typically amortize. We'll talk a little bit more about what amortization is, but if it's over $500, it would go under computer hardware, which is an asset account, as opposed to computer supplies. So anything under $500 would typically fall under computer supplies. Consulting fees expense, we're seeing this more and more, things like Fiverr, Upworks, those types of things, or if you have any other consulting or subcontracting, that would typically fall under consulting fees. Once upon a time, we used to use consulting fees as an income splitting method. We no longer do that. There's lots of reasons we don't. But so that's typically more the things like your individual consultants, and not so much your subcontractors. Your subcontractors, typically, we've got a category for that as well. But those would be things like Fiverr, Upwork, those types of things. Amortization expense. This is not something you would probably not be putting anything under the amortization expense. This is an expense that we as your accountants will report. This is the portion of your fixed assets that we're able to expense now. And again, we will discuss that in a little bit more detail when we get to the assets section. But for your sake, you shouldn't really be categorizing anything into amortization expense. You're just making that decision. Is this computer hardware or computer supplies? Are these office supplies or office hardware? That's the only decision that you really need to make when it comes to classifying your transactions. Your director's fees expense, again, this is a category typically used only by us. The way it works for most of our clients is as you take out money throughout the year, we will consider that a loan from the corporation. At the end of the year, we will look at how much money you took out of the corporation, less how much money you used of your own money to pay for deductible business expenses. We will sum those two numbers, and based on that, we will determine how much of that money you took out will become either salary or dividend, whether we will do income splitting. So once we do that, if we do declare a salary for you, the director, it will be reported here under the director's fees expense. But when you're coding your withdrawals from your corporation, you don't code them under account 790, you code them under account 150, which is an asset account, and it's called director's advances. Very similar, it's director's advances, not director's fees. So the fees are what we will declare based on the tax planning. The director's advances is the loan account that you will use when you're drawing money out. Or if you're putting money into your corporation, again, it would be the same thing. You would use account 150 to record that advance you are making from yourself to your corporation. Education and seminars, pretty straightforward here. The one thing to keep in mind is that more and more people are just getting this learning and education online for free. But if you are purchasing education and seminars, we'd categorize it here. And it's better here, like if you're doing any traveling, you would have for a seminar or conference, you would have the seminar or conference fee here, the airfare and the travel and the hotel under travel expense, which we'll get to. Employee benefits expense. For the most part, this is typically the employer portion of the CPP that we will record for you. In some situations where you have a health spending account or a benefit account for your employees, that could be expensed under here as well. But for most of our clients, this is just going to be the employer portion of the CPP. And again, we will track that for you. General expenses are meant to be a catch-all. If any of the categories we have don't fit your needs, use the general expense category and we'll help figure out where that should be reallocated when necessary. Insurance expense. Now this one's going to be a bit of a mouthful. And that's because, as I said before, there's a couple different types of insurance and there's a whole bunch of rules when it comes to insurance. I'm going to cover the main categories here first. So errors and omissions and medical dental. These two are both 100% deductible, no issues whatsoever. So if you've got either of these, they go right into the insurance expense without any question whatsoever. Now, disability is a little bit different. The rules with disability tell us that you can deduct it, but if you choose to deduct it, any benefit you receive from that plan will be taxable. And typically, because it could be a large lump sum, we want to avoid that being taxed. So typically, we would recommend to most people not to deduct their critical illness. Now, that is a decision for you to make. And if you are considering it, feel free to have a discussion with us and we're happy to work out whether it makes sense for you to deduct it in your specific situation or whether you should not deduct it and therefore have the benefit be tax-free if you do receive it. Now, life insurance is different still. And there's all sorts of different kinds of life insurance. But the important thing to know about life insurance is that it's specifically disallowed by the Income Tax Act, as I mentioned earlier, with the exception of if there is a bank covenant requiring the insurance, which for most of our clients, we only do notice to reader. So none of our clients would ever have a bank covenant requiring it, which means it's not going to be deductible for any of our clients. However, if you do have the beneficiary of the policy be the corporation, what that allows us to do is have an add back on the tax return. So what would happen is you would report the insurance expense and we would add it back on the tax return, much like we add back 50% of the meals and entertainment cost or the business promotion cost we mentioned before. So you give us the full amount, we add it back. What that does is it means that you're paying for that expense with money that has been taxed at the corporate tax rate. In here in Ontario, that's only 12.2% versus your personal tax rate, because otherwise you'd have to take the money out of your corporation as a draw and then declare that as a salary and pay personal tax before you could pay for the insurance. But by reporting it here and then adding it back, it never becomes a draw to you and never becomes salary to you, thereby allowing the corporation to pay for it, even though it's not deductible to the corporation. This is a really important differentiator that can make a big difference because, as I mentioned, the corporate tax rate is only 12.2%, whereas the personal tax rate can go as high as 53.5%. So big difference in the two. And depends where your marginal tax rate is as to how much the savings are, but it is a potentially large savings. Interest and penalties expense. Hopefully you don't have these. Let's avoid these at all costs. Make sure your stuff is filed on time. The one thing I want to point out when it comes to interest and penalties is when it comes to penalties with pretty much all taxes, if you have paid your corporate tax, your GST, your personal tax, and you file late, the penalty is a percentage of what's outstanding. So if nothing is outstanding, there is a no penalty because any percentage of zero is zero. So do everything you can to get your stuff filed on time. If you cannot file on time, make sure you get an estimate, an overestimate, and pay that before the deadline. And that way you will avoid the interest and penalties. So office supplies expense, much like the computer supplies expense, these would be office supplies under $500. And you would, if you have anything larger like a desk or any sort of office furniture, it would go under office equipment, which would be under your asset account. But other than that, all your office supplies that you might have, ink, toner, pens, paper, all that fun stuff, stationery, would all fall under office supplies. Next, we have rent expense. For most of our clients, again, you're probably not renting a separate space for your business. What we're typically claiming here is a percentage of your home office. The average person claims about 25% of their home office, and we have a calculation to help you figure out what that percentage of use would be, because this is another percentage of use account. And we're going to multiply that percentage by all of your costs. Now, if you rent, it's pretty straightforward. We're just taking the percentage of the rent, and if you are paying any utilities, the utilities. Now, if you own, what we're taking is a percentage of the mortgage interest. Now, this is not the payment you make each month. This is the interest only. So the bank provides you a statement at the end of each year that tells you how much you've paid in interest. So you might be paying, a couple $1,000s a month, but that's not all interest. That's interest plus principal repayment. So the only portion that we're able to deduct is the mortgage interest. So again, we can work with you to help you figure out what your percentage of use is. You just simply need to track, all your utilities, your mortgage interest, any repairs and maintenance, landscaping costs. And we do have a worksheet that we provide to all of our clients. It's a home office worksheet to help you figure out the subcategories that go into rent to know all the things that you can deduct there. We also have repairs and maintenance. Now, some might think of this as being repairs and maintenance for their home. This would be repairs and maintenance specific to the home office because these are going to be 100% deductible as opposed to repairs and maintenance to the home. So imagine that you redid your roof. We wouldn't take 100% of that roof cost. We would take the percentage of home office applied to that roof cost. But if you repainted your actual office space, we would take 100% of that under repairs and maintenance. So that's the big differentiator there. Next, we have telephone, which actually should read telephone and internet. So as I mentioned before, the big caveat here is your home telephone line is specifically disallowed, but all long distance, call waiting, additional lines, your cell phone, your internet, VoIP systems, all those would be deductible under the telephone expense category. Next, we have professional fees. And before I go to professional fees, I just noticed a question in the Q&A. Let me see what that says. Contractors direct related clothes, i.e. steel toe boots, rain gear, gloves, shirts, and pants that are heavy duty for work only. So if it's specifically for work only, we would typically expense those under advertising costs. Now, what we have right now when it comes to business clothing is a very unique situation. For years, we were very big advocates on deducting your suits and your dry cleaning and your haircuts and all of that. Now, unfortunately, CRA went ahead and found a couple people who were excessively aggressive, and they fought and won those cases. And as a result, what CRA has done is taken a stand that they will deny all of the business clothing unless it is a uniform. They will deny all business clothing. Now, there's certainly an argument that your suit is your uniform, but they believe anything that you would wear on the streets is not a uniform, which arguably could be steel-toed boots. Now, what it's important to know is this, again, is not specifically disallowed by the Income Tax Act. This is a position that CRA has taken. What that means is you can still claim this expense. They can deny it. You have 3 levels of appeals within CRA to argue the merits of your position. If they still don't agree with you, you could actually go to tax court and then Federal Court of Appeals and then Supreme Court of Canada if you wanted. Unfortunately, the problem is with CRA having basically an order to all of their auditors to deny this, it's going to be denied at all levels of appeals, which means the only way to win this is go to tax court. And very few people are willing to go to tax court for $1,000 worth of business clothing and dry cleaning. Now, until we start to see someone who's got very expensive taste and is buying $10,000 suits and is willing to challenge this, we are unlikely to see CRA's position change. Now, that doesn't mean that they are right. It means that they have chosen to take a position on that. And our job is to educate you on their position, allow you to make an informed decision, and make a decision as to whether you want to continue to deduct that. So I hope that answers your question. Now, where was I? I think professional fees expense. So typically, this is going to be your paralegal costs for incorporation, any legal costs that you might have, any costs for any other professionals that you might be engaging, including financial advisors, if those aren't categorized above under bank charges, which sometimes they might be depending upon how things are structured. So those are pretty straightforward, but again, typically a very small amount for most of our clients. Next, we have travel expenses. The most important thing in travel expenses is that typically we encourage our clients to report their parking under travel expenses. So of course, your airfare, your hotels, your trains, but also your parking. Now you could even you can expense TTC if you're not expensing that on your personal tax return. So obviously, if you're doing a monthly pass and you're expensing that on your personal tax return, you cannot double dip. You can never double dip, just for the record. But if you're not claiming it personally, that could go under travel as well. And then we also have a wages and salary expense category. This is typically for the salaries for non-directors of the corporation. This could be other family members. This could be other real employees, et cetera, et cetera. And then lastly, we have a non-deductible lifestyle expense category. So this is meant because we want to encourage you to track all of the money that you spend, including the non-deductible portions. And in fact, I think we have a chart of accounts that Jennifer's been working on that breaks down this non-deductible lifestyle expense into some further subcategories. So you can do a little bit of personal budgeting as well. Because like I said, I encourage everybody to track every single dollar that you spend and make sure that you are understanding where your money is going so that you can better control your finances. And also, if we ever come back and identify maybe something you missed out on inside your corporation that you weren't aware of that you could deduct, if you've tracked that and just put it under non-deductible lifestyle expense, it's very easy for us to grab that number and move it over and deduct it. But if you haven't tracked it and you haven't kept those receipts, it's going to be pretty hard for us to add that back in. Next, we should have our assets. So under assets, we do have a couple of different categories. We have automobile, computer equipment, computer software, office equipment, office furniture. We do have one or two clients who do have automobiles purchased under their vehicle. As I mentioned before, we do not recommend that you purchase a vehicle under your corporation's name because we are going to have a whole bunch of extra work that goes into it, thereby more accounting costs without increasing the amount you can deduct. So not providing any benefit for you whatsoever. In addition, the benefit of a corporation is it provides limited liability. But if you have your assets inside your corporation, the limited liability still includes those assets that are in that business, including your automobile if you have it there. Now we look at holding companies and stuff like that. When you start to build up retained earnings and significant assets, there are ways for us to shelter and protect that. There's usually a trick or two up our sleeves, something that we can do to help you when you start building up this net worth, because your goal really should be to start by organizing your finances, but then to build up wealth inside your corporation. That should be your objective. And only once we build up that wealth inside your corporation can we start to look at processes and strategies to transform that wealth into a legacy for you. So the other more common categories we're going to have is computer equipment or computer hardware, computer software, although more and more all software seems to be software as a service these days. You might have office equipment or office furniture that you would have under those categories. And again, more and more, we're finding less and less of that. Office equipment used to historically be things like photocopiers, which more and more people don't have. Office furniture, pretty self-explanatory. Desks, chairs, those types of things are still expenses that a lot of people do have. And typically, in most situations, are more than $500, which means we do need to amortize them. Amortization, as I said, means that we're able to take a portion of that expense, not the full expense in the current year. So basically, the government is saying, hey, this item has a useful life that extends beyond this financial year. So I want you to prorate how much of that you deduct across many years so that it more accurately reflects the real cost for the business. Now, it's all still deductible to the corporation. It just takes time before the full amount is deducted or fully amortized. So I guess we're just asking you to, in that first year, prepare. Oh, this is a really actually important thing to be aware of. So I'm glad I'm reading my own slides here. If you were a sole proprietor or you were just opening up your corporation for the very first time and you have existing assets that you want to transfer to the corporation, you can do so, but it's not transferred at its purchase price. Obviously, it's transferred at its fair market value. So you have to, prepare a list of all those assets that you want to transfer and do a fair market valuation. This is not replacement value. This is fair market value. And then we can prepare a journal entry for you to give you credit for this contribution to the corporation. So if you are starting out for the very first time and you do have any questions about that, please, again, feel free to reach out to your account manager and they'll help you figure out what you can deduct. And lastly, we just want to, give you guys some tips and suggestions on how to make sure you're tracking all this information in a way that's super easy and super fast. And that is with Dext or Receipt Bank. This is a tool that we give free of charge to all of our clients for as long as you are a client. We also give it to all prospects for 1 year free of charge. And what it allows you to do is to snap a picture of your receipt, have that receipt OCR'd and upload it into a client portal. You can then come in and download the images or download a CSV of all those individual transactions. Or if you are using something like QuickBooks Online or Xero, you can link that transaction so that it flows right into your QuickBooks or into your Xero software and connects the actual supporting image to the individual transaction on the bank statement or credit card statement. So you have what we call audit-proof financial statements. Because one of the things a lot of people may not realize is your bank statement and your credit card statements are not considered valid source documents from CRA's perspective. So they're fine for me to use to do your bookkeeping because I don't require the original documents to prepare a set of books. But if you ever go through an audit, CRA will require those original documents in order to consider the receipt, consider the expense to be valid. And that's for a number of reasons. First and foremost, the credit card statements does not provide a GST HST number where applicable. Secondly, it doesn't provide any line item breakdown or any detail of what was spent. As you can imagine, if you go to the Bay or if you go to Canadian Tire, there's a wide variety of things that you could buy that could range from being 100% deductible to being 100% personal, and anywhere in between. And they could also be from any category. So CRA wants to see the line item detail to see exactly what you bought, to be able to decide whether that item is legitimately deductible or not. So again, Receipt Bank is an amazing tool that helps you do that. We've got a webinar dedicated to Receipt Bank, so come check that out if you don't know how to use Receipt Bank. If you want to learn how to get a free copy, just go to cpa4it.ca, cpa4it.ca/receipt bank, and you can get a free copy of the software right now. And it'll be sent out to your website or sent out to your mobile phone within a matter of minutes. So go get that connected, start snapping photos today. And then the other thing it can do is it can connect to any online accounts like Amazon or Best Buy, which have online accounts, and it can fetch your individual invoices from the past and pull all those down, and then again, have that sort of collated into one place that you can spit out into a CSV that you can use for bookkeeping and data entry at the end of the year, or to link to a general ledger software like QuickBooks or Xero. So that is really my pitch for today. I know I went through a lot. I'm sure there's tons more questions out there. I'm going to open it up for a Q&A right now. But I do also want to let you know that we do have our networking group, which is facebook.com/group/the self-employed support network. We do offer other training sessions that I mentioned earlier. You can go check those out on our website, cpa4it.ca/events. And we do also have a ton of free resources for existing clients under our ShareFile website at cpa4it.sharefile.com under the free resources folder. And last but not least, the CRA website is a great place to find more supporting information and to get answers. You'd be amazed at the wealth of information that's often overlooked on that website. It's not very pretty, but it's surprisingly user-friendly when you use their search and their and the amount of data and wealth of information that's on there is amazing, to be honest. So we do have some questions rolling in. Some proprietor contractors purchase life insurance that includes work liability rather than pay for WCB. Is this expensed? So if it's a life insurance that includes a liability, you would basically have to look at the individual policy. I would suspect that a portion of it would be deductible and a portion of it would have to be added back. You have to look at the individual policy because, I mean, insurance is an amazing thing. It's used for a whole bunch of tax strategies. There's a whole bunch of, life benefits to it. Insurance is a great thing. It also demonstrates risk for profit or loss, which is a key thing when we're looking at personal service business. But insurance plans can be structured in an infinite number of ways. So it really is important to look at the actual individual policy to determine if it's deductible and whether it's 100% deductible or if only a portion of it is deductible. So I hope that answers your question. And I'll leave it open for just another minute to see if we have any other questions. Otherwise, I want to thank everyone for taking their time out of their schedule to join me today. And we'll see you back in a couple of weeks with another webinar. And of course, if you do remember a question the minute we hang up, go post it in our Facebook group and we'll do our best to get to those questions in a timely manner, or do a whole webinar dedicated to those questions. It's a great place to answer your questions, get your questions answered free of charge without having to sit down with an account manager who will charge you for their time. So it looks like no more questions are coming through. Thank you, everybody. I'm going to sign off now and have a great Tuesday. Bye for now.